This is the big news moving steel markets and lots of other stocks as well that are related to it. The Trump administration, 25% tariff on steel, 25% tariff on aluminum. We're going to talk briefly about what the tariffs mean, the implications for domestic steel producers, but really thinking more long-term about where investors that are interested in investing in steel specifically, where they might want to look. You ready?
Yeah, it's not that often that steel's a really hot topic in the news, so gives us a good chance to talk about it.
All right, let's get right to it. I'm Jason Hall. This is Investing Unscripted. Tyler and I are going to have some really interesting stocks for you to think about. But if you're looking for even more great stock ideas, you should go to our special link. Go to fool.com/unscripted. Again, fool.com/unscripted. Go to that link and you can get access to the Motley Fool's 10 best stocks to buy right now. Go check that out. Tyler, take a minute here and break down exactly what the Trump administration has imposed and what it means.
For the past 15 years or so, we've had some pretty steel has been an industry that as the U.S. has become a little bit more protective. We started with steel tariffs under the Obama administration. They were expanded under the first Trump administration. They've all kind of been there in some degree, either in a targeted area to boost production of specialty steels, or in this case, similar to what we saw during the first Trump administration, is blanket tariffs across the world. There's a lot of places globally where there is, we could call it excess capacity, most notably China, with slowing steel demand from construction there and a lot of excess capacity. There's been a lot of excess cheap steel that is being exported from there, and what has been determined as dumping steel, selling it at unprofitable prices and non-competitive, which is kind of in violation of some trade agreements. So with these tariffs, it's trying to hit back at this idea, but also just it's a protective measure, more or less, to boost domestic production in steel, investment in steel production, and in a way protect the bottom line for steel producers in the United States, because a lot of steel production in the United States has either dwindled. It's not exactly the most profitable industry in the world for various reasons, and there's been a lot of consolidation because there's been some weak players that have been kind of struggling with it. One part of the reason that the United States Steel was a target for Nippon Steel was that the United States Steel has kind of been like the problem child of the steel industry for quite some time. They've been barely profitable most of the time. They had some windfall years during 2021, 2022, but that was how it happened across the entire industry. Supply chain woes and things like that allowed a lot of steel producers to raise prices. And it was we'll call it the bumper crop season for steel producers. But that has gone away, and now this United States Steel is this American icon of steel production, going back to Andrew Carnegie, and it's been struggling. And so there's, I guess, the theory is that by protecting steel industry in the United States, there's some strategic reasons for it, there's some economic reasons for it as well, but it does have impacts down the line as well. Obviously, the direct beneficiaries is anybody who's making steel. The people who are going to likely suffer a little bit because of it is going to be the people who manufacture products from steel, automotives, appliances, construction, things like that. And then if they can't, well, they're going to try to pass the price on to its end consumer. If they can't, then it's going to be a hit to the margin. So it's not an unprecedented move. We saw it in the prior Trump administration, and how long these last, I don't know, because again, they were trimmed and made a little bit more targeted under the Biden administration. So it's not like we can expect this forever, but it's kind of where it is for at least for the foreseeable future, which could be, I don't know, a week, a month, a year, who knows?
Yeah, it's definitely something that I think we should remember as investors whenever we're taking investing and the blocking and tackling of what businesses are supposed to do well, and supply and demand in the marketplace, and how that affects cyclical industries with high fixed operating costs like steel manufacturers. And then you have the politics, the geopolitics, trying to not let our partisan positions bias us in making bad investing decisions. So that's our goal, is to talk through those implications and help anybody that's looking at the steel market right now understand how to profit over the long term and the short term, and think about the risks as well. So these are the major players in U.S. steel production. This isn't all of them. There's a lot of other companies that are involved in different parts of the value chain, but these are the ones that are largely the raw materials producers, the biggest ones. And you can see that's this week, since the market closed on Friday. We've seen a big spike. The stocks have kind of moderated a little bit, but there's already front running that's happening here on the expectation that, writ large, the steel U.S.-based producers of steel are going to benefit from higher prices. They're going to be able to raise their prices. Now, I do want to talk about some of the misconceptions that are out there in terms of what it's going to mean for their ability to increase their production because of the way that steel is often specialized. And if you're an appliance manufacturer in Ohio and you're sourcing the steel for your frames, there may be a Canadian producer that you're using. That's what they make, right? They make that grade of steel and that alloy. Or if you're buying electric motors and the steel or maybe the aluminum for the electric motors is being produced in a specialized facility, that's what they do. And it's not like you can just pick up the phone and you've been buying that from a specialty producer overseas and call Nucor and say, hey, can we start sourcing these from you next week? That's not how the steel industry works, right?
No, there's a lot of specialty steels that some companies don't make. And if that, maybe the theory is that if you impose tariffs firm enough and long enough, that it would incent steel producers to make the investments in those things. But that takes multiple years, right? If you're building up ground up facilities to build a specialized type of steel, that's going to take years. And whether or not manufacturers are going to have the patience for that is always a challenging question to ask. But there are some realities. Is like there's of certain types of steel production. So as the current steel industry is constructed today, that we just don't make in the United States anymore or ever did, and does require some form of import. And likewise, we do actually export quite a bit of steel as well. So it's not like it's a one-way trade where all we do is import steel. Just for example, I think that we actually export more steel to Mexico than we do than import. So on a net basis, we're an exporter of steel to Mexico. So oftentimes these things are two-way trades to try to fill in the gaps. We see it a lot in like energy too, where like we produce a lot of diesel that we don't necessarily use in the United States. So we ship to Europe. Europe makes more gasoline than they use. So we just trade. We're like one ship filled with diesel goes to Europe and then they fill it up with gasoline and comes to the United States.
It's the structural reasons. It's the feedstock of the kind of crude oil that they're using, the way they've optimized the refineries based on that crude to get the maximum amount of product out of it, that you can't just flip a switch and change those things. And it's the same thing in the steel industry.
Yeah, generally speaking, it's just end demand in certain places is different versus your actual like production capacity. And so we just have these trade-offs. There's some pricing discrepancies there, but overall it works.
So we're already about 7 minutes in here, and we've just talked about the overall fundamentals of the industry and some of the realities that the decision makers are going to be facing, that any structural change we're going to see in the global supply of steel and kinds of steel is not going to turn on a dime. And something as unpredictable as tariffs is unlikely to change that, Tyler. I think that's a big key. Is no CEO at one of these multi-billion-dollar companies is going to go all in on adding capacity in a specific kind of imported steel just based on the tariffs. That's a massively risky decision that's unlikely to generate any kind of return in the near term. So let's think about the steel market right now. And if investors are looking at it, how are you thinking about investing in the steel industry right now? Is this an area that you're actively looking to buy, watch lists, or are you looking to avoid right now?
Number one, I just want to state clearly, like, I don't think the tariffs really play into my investing thesis for any steelmaker in the United States. I guess it's a nice to have, but maybe it doesn't last very long. So who knows? So
their businesses have to be built beyond any sort of government intervention.
So if I look at businesses one that I own, and I would add at opportune times, I would say is, for example, Nucor Corporation. It's a stock I've owned for a long time, and it's a unique business model. They run a different type of steel production that involves a lot of recycling of old steel. So it's a cheaper, more nimble process than like the traditional steel blast furnaces that use like iron ore and things like that. And also just the business itself is set up more nimbly, where non-union employees that actually have like performance-based compensation, not just for themselves, but also for the entire profitability of the business. So like their operating costs can go up and down with the steel market. So there's a lot more nimbleness to the business. And also the management has a great track record of counter-cyclically investing. So like when the market is in the doldrums, they go make acquisitions because people are hurting. And when the market's expensive, they do a lot of greenfield expansions and things like that to build out capacity because it's cheaper to build. It's one of the better run businesses out there. From a valuation, it looks okay, but this is a cyclical industry. And sometimes when things look cheap in cyclical industries, it might just mean we're at a high point in pricing. Something just to keep in mind.
The yellow chart here, this is Nucor Corporation's free cash flow. First of all, you'll see very lumpy, very up and down. The purple is US Steel. This line right here is zero. So anything below this is cash burn. And you can see going back to 2000, Nucor has consistently, even during the down period, like this is the global financial crisis here, this is the pandemic, consistently generate positive free cash flow, while US Steel has a history of dipping into pretty substantial cash burn. I'm going to add another steel stock here along with those two in Steel Dynamics, which is one that I think is really interesting as well. And so that changed the color. Nucor is now blue. Steel Dynamics is yellow and the purple is US Steel. And you see Steel Dynamics also has a consistent, even though very cyclical, consistent history of generating positive free cash flow in most markets, dipping a little bit in periods, mostly when they're making big capital investments. And like Nucor, Steel Dynamics uses electric arc mini mills, gives it a lot of variable cost structure, the ability to ride through those cycles. And it's taken a similar approach to Nucor to expansion. Steel Dynamics is one that I own. It's been a big winner for me. But right now I'm watching. I'm not looking to add right now. I think you have to be like the operators of these companies. You have to be countercyclical. And if you're looking to make external acquisitions, in this case, buying shares of these companies, you want to do it when everything is cheap. And now is not that time. The stocks right now, I think investors would do better to be waiting and watching. And there's other better places in the market right now to invest. Check out some of our other videos for those ideas.